Steve and I are so excited to have you here. This is something that we've always loved doing, is bringing the monthly meetups to you guys, and it's been a bit of a change for us coming in from the in-person to the online. We did almost 4 years straight of doing 9 meetups a year, and then having to switch online was a bit of a change for us, but we've really enjoyed the process. It allows us to get in front of a bigger audience and see more people. For those of you that are tuning in live, we're happy to answer any questions that you have tonight. You can just type them in the box below, and we'll be able to ask the panelists as they come in, or they'll be able to see them and answer them. We are recording this, and we're going to send it out to the community as well. So for those of you that are watching this after the recording, please feel free to reach out to us if you have any questions or anything going on. And I'm going to start by just sharing our slide deck. There we go. Welcome to tonight's meetup, guys. Super excited. We're going to kind of fly through this. It's going to be a nice and quick one. Hopefully we'll be able to get through this tonight. Basically, we're just going to open up who we are. Then we have Meg and Betker, who you can already see is on here. Again, talking about some important stuff about insurance, life insurance, things like that. We'll be having Steve Pearce come on from Seafers Insurance, coming in to talk about some house insurance policies and some of the drama that's come from all the condo insurance policies and things like that. And then Steve and I will close it out, hoping to be done roughly about an hour and a half for you guys, probably sooner, but it depends on the questions that come in and the things that you have.
Oh man, I'm not gonna lie. I miss everybody. I miss our meetups, like having 100 people in a room. I miss the energy. I miss just shaking hands and hugging people. And typically at Gorge Fail, there's a beer or two that is involved. I'm sure a lot of people out there are missing it as well. One of the things I just love doing, in the physical meetups where we're all live in person, is just seeing like who's new to the group. I think a lot of people on this call, I think we probably recognize a lot of people. If there is anybody new who hasn't seen us before, leave a little comment here in just the chat. You can see if you're new to Zoom, it's just on the bottom of your screen. There's a big green square that says share screen right beside that. There's a Q&A and a chat button. So if you're new to the group, let us know. We'd love to connect with you. We'd love to, we do this on a monthly basis. Our community has a ton of educational components to it every day. Lots of great questions, and Randy and I just get all jacked up helping people get into real estate. So I just, Kevin, this is your first meeting. Welcome to the crew, my man. Super stoked to have you here. Like I was just saying, like we're just thrilled to educate people. Our mission statement is, we'll get to that point. We're rushing things. Pump the brakes, Steve. I'm just getting excited. But welcome everybody who's new. For everybody who's been here before, welcome back. We're stoked to have you all.
Who are the REINVESTORS? Steve and I together combined to make the REINVESTORS. We started out about 4 years ago with a monthly meetup. 2 young guys that had very little experience in real estate other than just buying our primary residences, and had ambitions for seeing an opportunity and helping people get educated, financially educated in this space, and then using that money to invest in real estate. And there's no better way for people to take us seriously than to stand at the front of the room and bring in the experts to teach. And so that's what we did. So we started a monthly meetup 4 years ago, brought in people like Megan and Steve, who you'll see later, to speak and be the experts. And we just helped facilitate it. From there, we learned as much as we could, and then eventually started buying properties ourselves through joint venture partnerships. While we were doing that, we are also running the educational company and teaching people how they can pull the equity out of their homes and invest it back into real estate. Something we found was something that's not talked about very often, especially 4 years ago, just as I think real estate's grown quite a bit over the past 5 years, was really teaching people how they can start using their equity or their leverage they already had to start investing into real estate. Since then, we've been able to go buy everything from single family homes with suites in them, all the way through to a 5-plex, into some development lots. And then just today got the news that Steve and I officially closed on a 12-lot subdivision that we'll be building on over on Salt Spring Island. I'm sure every one of you has seen our posts about it and what we're working on. So We'll probably dive into that maybe at the end of the webinar tonight, a little bit about what we've been doing. But yeah, so we've been able to do everything from single family to commercial, all the way up to construction and development now, which has been absolutely amazing. And we are, our mission statement is we're on a mission to financially educate and 1 million people and inspire them to invest in real estate so they can start living a more fulfilled life. And that really comes from what our company is all about. You know, a mission to financially educate 1 million people is our monthly meetups and our online platform for us to reach everyone. Inspire them to invest in real estate means that we will forever be investing in real estate and doing that on a day-to-day basis as our full-time job. And then allowing them to live a more fulfilled life is all about giving back. We love giving back. It's a huge part of what we do. And it's the reason why we push ourselves harder and harder every day, because we are trying to always build more wealth so that we can make a bigger impact in this world.
So a huge thank you to everybody who donated this this evening. I don't know what the tally was, but the last I looked, we had a couple $100 in there. It's a little bit less than what we typically get from the live in-person ones, but understandably, everything that we get from our meetups, from the online piece as well as the in-person ones, we give right back to Kids Sport Victoria. You know, God knows that they need us more now than ever. So we're thrilled to be a part of them. You know, we just got notice that their annual golf tournament is postponed, possibly even canceled. That's usually in like about 2 weeks from now. It's disappointing because Randy and I both love golfing, and obviously it's a great cause to support. But they're a really great organization. If you guys haven't heard of them before, they basically help sponsor families in need for, you know, in the Victoria area. And it's actually like nationwide as well, but for the Victoria one is the group that we support, and they help put kids through sport who can't financially afford it. So sport for us has been just a monumental piece of our lifestyle, of, you know, who we are as people. It's helped us in business, and you used to learn a lot from it. We wanted to give that back by contributing back to Kids Sport.
And I'll thank our sponsors, and Steve, I'll let you do the intro to the new one. Just a huge thank you to our sponsors. Without them, we wouldn't be able to put this on. Usually this is in person and live, and usually we have a venue to pay for and cost to cover. And these are our sponsors that cover them. Now they're helping us cover all the online content and the growth online that we're doing. Sick Law Group's absolutely amazing. Our lawyers here in Victoria that are crushing it. Real File CPA, based out of Toronto, online. So they do everything on cloud-based. So if you're looking for a good accountant, check them out. The Green Mortgage team, based out of Vancouver, but again, works all across Canada. They've absolutely helped a ton of our investors. They've been absolutely great and amazing, and specifically work with real estate investors so they can know the products getting done. Burkhart Construction, who's local here to Victoria, one of the best guys when it comes to actual understanding of what the construction industry is. Century West Financial, who we have today, that's Megan Betker's company. She's been a huge support for our community, making sure everyone has the right insurance policies in place, as well as working with them on the investments and helping them understand where their cash flow is at in their properties, and just making sure that they're staying on track with all the moving parts of their stuff. And Steve will introduce our newest sponsor and how we're working with them.
Yeah, so we got a new sponsor. I don't know if you saw our video in our community a few weeks ago, but we are happily welcoming the Prime Real Estate team to the ship, to the crew. We're all captains in this together, and we wouldn't be able to do this without our awesome sponsors that give back to a lot of our community members, and they're just experts in their space. So Kyle Kerr is somebody who we've worked with in the past, and just really align well with kind of like our own independent goals of financial independence, education, kids sport being a huge piece of it as well, and then obviously the real estate side of things. Unfortunately, Sherry wasn't able to continue working with us into our meetup. She has a lot going on with her own meetup and her developments and such. But we're stoked to see if Kyle can fill her shoes, and we're happy to have him and the rest of the Prime team as a part of our sponsorship team to be able to contribute a lot of value for you guys going forward.
And as always, we have a Facebook community. Guys, if you want to follow along with us on our journey and have questions, things like that, hop into our community. It's just on Facebook at the REINVESTORS community. Absolutely amazing. Lots of questions. There's a few questions in there for tonight that we'll be asking from there and getting a lot of support from. So if you are looking for a community to get involved with, hop into there. Totally free. Just happy to help and serve. We do a lot of live Q&A panels in there, interviews, things like that. So especially with all the time that Steve and I have now with all the online stuff, we'll be back coming back on now that we've got some things sorted out. We'll be doing more interviews, and we've got some cool stuff coming down the line for you.
You know, prior to COVID, you know, us as entrepreneurs, we didn't really have weekends, right? But now all these other people who are kind of working, you know, 8-hour days all the way through the week, they're kind of catching up to our lifestyle of never having a break. But yeah, we're really excited about tonight. We got two really phenomenal speakers. You know, most people know who Megan is already. Megan's been a huge help. I think, you know, right from get-go, you know, you've been a part of our community as probably our number one, you know, our first sponsor, and you have really deep roots in our community. I know you've helped a ton of people locally here, you know, who come to the in-person ones as well as through the online platforms. You know, you work with, whether that be health or group or life insurance pieces. You're also in investments, and specifically out of that, I'll highlight that you're also a real estate investor, and so which is really unique, I think, for, you know, for financial planners and stuff and advisors in that space. It's not often that you get somebody who's not only competent in these different areas, but also like well experienced. So you're an excellent asset for us to have, to be able to give back a lot of value to our community. And I've just heard, you know, wonderful things from people working with you. So I'm really excited to hear what you've got to say today. I know that I'm going to learn something. And Megan, welcome. The floor is yours.
Awesome. Thanks, everyone. And thanks for the warm welcome, Steve. I feel really loved now. I've been missing all my socialization, so I just got my little warm and fuzzy.
My heart's exploding right now. So I guess yeah. I need people.
I got to absorb it all because that's all I'm going to get. So I'm going to just share my slide deck here. Share my screen. Okay. Well, as Steve mentioned, everyone, I'm Megan Betker, and I'm with Century West Financial. I am an investment and insurance advisor here in Victoria, BC. I don't know if there's people from out of province, so I just want to make sure that's clear. And much like Steve said, I love real estate both personally and as part of a person's overall financial plan. And I am very fortunate that I'm able to encourage my clients to add that into the portfolio and really educate them on how doing so can get them reach their goals a little bit quicker and get them to their financial future that they're working really hard for. So tonight on the agenda, I've been asked to kind of speak a little bit about and provide some education surrounding the super exciting world of insurance. I know you guys are all just riveting in your seats there. But we're going to talk about how to protect yourself, your loved ones, and large investments in real estate. So I'm going to start with going over what Mortgage Protector is, and that's the essentially plan that's provided by mortgage lenders and banks to cover outstanding mortgage balances, and just how this product differs from personally held life insurance to cover a mortgage balance. From there, I'm going to go into how you can protect your financial interests when you're looking at a joint venture arrangement, how insurance can be an alternate asset class and accumulate returns. It's been a hot topic for me lately with the volatility in the markets. So I want to touch on that. And then finally, I'm just going to give a little bit of updates things that have happened in the insurance industry since this COVID-19 has begun. Because there's been probably more changes in the last month and a half than in the past couple decades. So it's a big time for my world. So first of all, I just really wanted to clarify, and I think that Steve will potentially appreciate this, what mortgage insurance is, because this term is thrown about and it's really confused with home insurance because people use those terms interchangeably when buying properties. So there's a lot of different types of insurances essentially when you are purchasing a property. So I just wanted to differentiate to make sure that everyone has that, at least the basis. So mortgage default insurance, which is commonly referred to as the CMHC. So that's mandatory in Canada for any down payments that are between 5 and 19.99%. So the mortgage default insurance, it protects the lenders in the event that a borrower stops making their mortgage payments and defaults on the overall loan. So it's protecting that lender. And for that reason, when people have CMHC or a Genworth insured mortgage, they usually get a lower interest rate because that lender is protected on a different level. So that's one type of mortgage insurance. The next is what Steve's going to probably talk about a little bit later. So is home insurance. So that is a form of property insurance that covers the losses and damages of an individual resident. And it also covers like the furnishings and your appliances and your contents within the property. And that homeowner's insurance also provides against like liability if someone came on your property and got injured. So that's what all kind of falls under that home insurance title. But again, like I said, a lot of people do use the word mortgage and home interchangeably. So next there would be that mortgage protector. So this is the life insurance policy that claims to pay off your mortgage if you die prematurely. For this coverage, the lender is the default beneficiary, and they don't really go into too many details when you're looking at this coverage, but we're going to talk about that a little bit further. And then there's personal life insurance to cover the mortgage. So when I use the term mortgage insurance, it is with the idea that it's going to be a personal life insurance product to cover the mortgage. So you can see how amongst these 4 different types of coverages, how it does get confusing. So if you know someone that is purchasing a property, then maybe you can help educate them on all these different types of insurance terms that are going to be thrown at them before they go into that process. So it's a little bit less overwhelming for them. So let's go into looking at that insurance to cover the actual mortgage balance. So we're going to look at differentiating the different types between the mortgage protector plan and that life insurance to cover the overall mortgage. So when we're looking at this type of insurance, the idea behind it is you buy this house and you essentially have just taken on this huge investment, yet huge debt. And something that we really want to think about is the fact that what happens if we can't repay that debt. So if you or your partner or your spouse passed away, could you still afford that overall mortgage? Could you afford those monthly payments? And that's why this type of coverage comes into play, is to designed to address that specific issue by providing enough money to pay out that outstanding balance if someone does pass away. So when people are purchasing a property, what I envision, because I've been in this same seat myself, is a person sitting at the bank or in their mortgage broker or lender's office, and they're likely stressed. They're signing their lives away. They're making a huge either investment or purchase of their first residence, and then they're offered this mortgage protector plan. So the person that is doing their mortgage is required to offer them the mortgage protector plan. So, and it's part of their liability, so they have to offer it. And you can either accept or you can waive that coverage. So you're already your head is in the clouds because you have all these things on your plate, and then you're offered this and you're like, okay, well, this is going to pay off my mortgage if something happens. Perfect. It sounds super easy. You're not really told any other details about it. You just either agree or you don't. And that's kind of as far as the conversation will go. I have the application sitting with me right here for when I've done some of my mortgages. And there's 5 questions that they'll go into if you accept that coverage. And in the fine print, it says, if I am ineligible, I waive the coverage. But if you're not an insurance agent and you can't really decipher these questions, you're not going to have an idea if you're ineligible or eligible. Most people, for the most part, do think that they are healthy, and usually are a lot more optimistic than an insurance company is going to look at them. I'm glad that we're positive, but that's not necessarily how the insurance company is going to look at it. So for those of you who may have been in this exact situation, or maybe in the future, or if you know someone that has purchased a property and would have sat through this question, these are great people to bring this up to, and I hope that you can take some education away from tonight and pass it on to those people. That would be my hope from what you take away from this whole presentation.
Good question.
Yeah.
So you were saying that like the insurance people were, they might think of us as healthy in a different type of category. What's a common piece there? Like, I feel like I'm a healthy dude. What would be an average piece that the insurance providers be like, nope, you're wrong, Steve?
Okay, so someone that, for example, has some history of, let's see, burnout or depression or things like that. I might think that I'm healthy right now, but how an insurance company is going to assess that is going to be completely different than myself, right? Like, I feel fine and happy today. Maybe I had depression 5 years ago, but an insurance company is definitely going to take that into account. Some people have taken, or they've gone and gotten a test. They had heart palpitations one day, for example. And they went in and it was nothing, but because that is deemed that they went and had a test for something like that they would fall under one of these questions that they would likely mark yes, and the answer would actually be no. So that would make them ineligible, and they wouldn't even realize that they're answering this question incorrectly, making them ineligible. So we're going to go into that a little bit further in the next couple of slides. So yeah, I'll go over that a little bit more detail. So one of the main details that I want people to take away from understanding between this MPP, Mortgage Protector Plan, offered by the lenders versus having a personally held life insurance policy is that the mortgage insurance that the lender is offering is protecting their loan to you by having you pay the monthly benefit or the monthly premiums to cover that balance. So it's a really, really good deal for them. But one important detail to note is that the benefit that you're paying for actually decreases as you pay down your mortgage. But the cost of that premium remains level for the term of the mortgage. So if you did a 3-year mortgage or a 5-year mortgage, that stays constant for that time. So looking at the slide, if you started out with a $500,000 mortgage, not necessarily living here in Victoria, and then after 5 years, you've paid down, let's say $60,000, you're at $440 owing. You've been paying for that same $500,000 worth of coverage, but you only have $440,000 of actual coverage. So not necessarily ideal. When you're looking at having a personal life insurance plan to cover that mortgage, that $500,000 mortgage you took on, whatever you elect to have as the amount when you take on that term of the policy, that is what you're going to be paying for. Neither of those are going to decrease. So in this example, you're purchasing the right to essentially receive $500,000 of term life insurance for as long as you have that outstanding mortgage balance. So even as it goes down to $440,000, you would still get $500,000 if you needed to claim. And then essentially your beneficiary would just have some surplus funds to do with as they see fit. Yeah, so you're just whatever you're paying for is what you're getting, not necessarily with what happens with the MPP plan. Now on to what I think is the most important difference between these products and why I really want to emphasize that these are completely different products, is something called post-claim underwriting. So what post-claim underwriting means is that the insurance provider will actually go back and assess your medical well-being or your risk at the time of death or at the time of claim, as opposed to when you actually fill out that MPP form with the lender initially. So in a post-claim situation, the insurance provider can review your entire health history and deny a claim based on any of those pre-existing conditions. And that kind of goes to what I was just mentioning. So if you had gone in to see the doctor because you had heart palpitations, because you thought you had a heart condition, well, that exactly what this application says. You would answer that you had never had an issue related to your heart, but going and getting that test can negate that. So, and the unfortunate part of this is that the mortgage broker, the banker, the lender that is sitting there and having you fill out this MPP, they're not insurance agents, so they can't go through those details. They haven't done any training behind that to be able to flush that out for the client. So I don't think that they're trying to deceive you. It's just, unfortunately, that's how this product was designed. CBC Marketplace did an expose a while back, and I'll actually link it into the REINVESTORS community after this if anyone wants to watch it. But it just goes through the differences and how the providers of those lender provided policies, or how they're getting out of having to pay the claims at the time of an event happening, such as a critical illness or a death. And that's when people are so stressed out. That's when they need the money, that they don't need to be fighting an insurance company. And that's where the benefit of having that personal held life insurance policy, you do the medical assessment right when you do an application. So before you even pay a cent, you know if you're going to be covered or not, or what you won't be covered for, before, again, like I said, before you would even pay $1. So much better than paying for 10 years, thinking you have coverage, something happens, you go to file a claim, and it's denied. So that's what I think. I really want that to be avoided. And I don't think any of us would want to be in that situation.
No,
A few of the other differences between these products, the lender provided product, the lender is the beneficiary. You don't get to choose. Personally held life insurance policy, you get to choose the beneficiary. And the beneficiary can choose what to do with those funds. And I think that's an important, I guess, just little note, because maybe I don't, if my partner passed away, I know he's gonna not like that I'm talking about this, maybe maybe I don't want to pay off my mortgage. Maybe I have no problem covering my mortgage, and I want to use that money to go invest in another property, which will pay my mortgage. So maybe I want to structure it a little differently, and just having the beneficiary being allowed to choose what they want to do with those funds just gives them that flexibility. And finally, premiums can go up over time with that lender provided coverage. So a lot of people do like a 3-year mortgage or a 5-year mortgage. And likely over the actual 25 or 30 years of a mortgage, a person will switch lenders, who knows, 3, 5, 10 times. I know I've had 3 different lenders, and I've only had mortgages for like 7 years. Each time you switch lenders, you are signing a new policy. You're going to have a new premium based on an age of however many years older you are. And with insurance, as you age, insurance gets more expensive. So that's the benefit to having that personally held life insurance policy that you got originally. That amount and that policy will follow wherever you go, no matter what lender you have it with. They don't care. It's not tied to that specific mortgage, it's tied to the individual. So I think those are like some of the biggest differences. If anyone has any questions, then you can post it in the chat, and then we can kind of chat about that a little bit more after.
There are a couple of questions here on this topic. Let's just hop into it.
I don't know if I can see them while my screen is shared.
No worries, I can ask them here for you.
Okay.
Kevin's asking, generally speaking, is mortgage life insurance more expensive than term life insurance policy for the same coverage?
Usually what I have seen is that the personally held life insurance is cheaper because they're assessing more factors, as opposed to when you look at the MPP, they're kind of lumping you in with, say, a huge pool of 50-year-olds that do smoke, or 50-year-olds that don't smoke, because there's not a lot of questions that they're all asking on here to assess the differences. So it's almost like it's a group plan essentially, right?
Mhm.
So like on this specific one, this was for a mortgage that I did with, and my father-in-law is the co-signer. And he was 55 at the time, and they were going to be asking for $563 a month for the life insurance, which is insane, like absolutely insane. I have not seen a time that I have not been able to find a term life insurance policy that is more affordable and a more secure and going to actually pay out compared to these MPP. Now, one thing that they've done is they have stopped showing you what the amount will be. They send you documents after now showing what it'll be. So you can't just go from the mortgage lender's office and then bring this to me and be like, can you beat this? Because you don't necessarily know anymore. And I think that that's why they got rid of that. But yeah.
Gotcha. I had a question here actually. And so it's about the MPP and like using your $500,000 home example type of thing. You know, if we get that 2020 and it's worth 550, as the home appreciates or depreciates, do we have to update our policy like every year, or what's your kind of advice for that? Because if it's, you know, 500 and then 4 years go by and it's now 750, you know, I want to make sure that the whole thing is covered, especially if I have, you know, a HELOC or something in place.
If you're going to be putting in a HELOC, or if you think that you will change mortgages and essentially like take on more of a mortgage, I usually preface to people that we would look at a larger policy now. Like for myself, I know that I'm going to move a ton. Like realistically, I just know that that's going to be the case. So I know I'm going to be taking on bigger mortgages because I live in Victoria and I want a really nice place. So I plan for that, and I can show people different how that's going to look for them. And the thing is that the younger you do it, the cheaper it's going to be. So if you're doing it now, it's likely going to be more affordable than if we did the 500,000 now, and then in 5 years you're like, okay, now I have a $750,000 mortgage, and adding it on then. So it comes down to budget and looking at having those conversations to kind of determine where you think you're going to go.
Gotcha,
but just
gotcha.
because we don't usually take in the value, right? Because you're more concerned about paying off the debt. So the debt usually doesn't go up unless you're kind of like upgrading properties per se.
There's a few things I absolutely love about this. The fact that you get to choose what you do with the money is absolutely amazing. And if you've paid off 20 years of your mortgage, you don't just get the remaining 5 years covered under the premiums. You actually get the 20 years you've been paying into it. Massive factor for me, and that's just an automatic game changer. I don't know why you would even go with the mortgage protection at this point.
It's just for lack of education. That's why people do it, right? Like it's just they don't know.
And then the ability to know exactly what you're covered for when you go into the process versus not knowing what you're going to be covered for when you get the mortgage stuff. So at least getting it all done now through like how you are today, you know exactly what you're covered for, versus with the mortgage protection plan, you have no idea what you're covered for until something bad happens. And at that time, you don't want to even discuss what your health is. You just want to get paid out. So with those two factors alone.
Insurance isn't supposed to be a gamble. Insurance is supposed to be paying for that peace of mind, right? Not paying and hoping it'll work out in the end.
So
that's kind of what we're trying to avoid, right? So
just simplifying those two processes that I didn't even think about make me absolutely just ecstatic, because those two pieces alone make every person on this call and that watches it should reach out to their insurance broker to find out about what their options are, because that
look at their mortgage statement. If you have a mortgage statement and you're not sure, because the premium gets lumped into your mortgage, so it won't look any different when it comes out of your account, and it's just all added in there. So go back and check out that mortgage statement. You might have gotten it, you might not be aware, you might have forgotten. People have a little bit more free time right now, so it's not a bad time to be reviewing those kind of documents and making sure that they're adequately protected. So.
Amazing. There was one other question here that says, I'm wondering if local credit unions require this insurance.
Require it?
Yes.
Like, I guess I don't really understand. Do they require the MPP, or just that you have the insurance overall?
That was just what the question came in as. I'm wondering if local credit unions require this insurance. I'm assuming it's about the MPP.
So every lender is required to offer it. So people taking on the mortgage can either accept or waive it. They don't require you have mortgage and like this type of mortgage insurance in order to get the mortgage. You may need that CMHC that I had mentioned earlier if you don't have 20% down. But other than that, there's not usually a caveat saying that you have to have this, because realistically, if you don't have this, we want this to be to your benefit, right? So they are gonna come after and take your home if you can't pay that mortgage if something happens. So they don't really care, right? They have that asset behind it. That's why they're lending you funds on an asset. It's secured. So this is your benefit. So I've never seen it as a requirement to get the mortgage from either a credit union or a big five. I've never seen that.
Beautiful.
All good?
All good.
Okay. So now we are going to jump in just to a brief chat about joint venture insurance. And the reason I want to bring this up is because I see a lot of people in the REINVESTORS community talking about joint ventures and looking for partners. I have clients that have used this arrangement. I've used it. It really is a great option for being able to invest. Randy and Steve have done it a lot of times. But when you're partnering in financial related transactions, I always recommend making sure that you are planning for the various situations that could come up and ultimately affect you financially. So some of the things that people don't really think about and don't necessarily put into those joint venture agreements is what happens if someone passes away, or does that person's spouse just become the new partner? Do you want that person's spouse becoming the new partner? That's a whole nother thing. Does that spouse just want their money out, so you have to sell that property right away? And this, I also heard it more recently. I was sitting down with a client and they were in this type of transaction previously, and their partner's spouse was diagnosed with, it was their partner, was diagnosed with cancer. So he was not working, his spouse was not working, she was taking care of him. They were accumulating some debt from not being able to work, and they needed their money that they were investing into this property out. So unfortunately, they had to sell, and they sold at a loss just to be able to recover those funds. There was some ill feelings on that relationship for having to do so, because the healthy partner had lost that opportunity, and they lost money as a result. So these are the type of things that I don't see often in joint venture agreements, and I think really are important, because I think they can blow things up. So I just wanted to go over a pretty simple example of how one would look at covering these type of scenarios. So in this example, I use 3 individuals purchase an investment property together, equal interests on the property. They are all on the mortgage, and they have a joint venture agreement. If you're doing that, I definitely recommend having an agreement in place. So I tried to keep this as simple as possible. So we're going to look at an even purchase price of $1 million, so $200,000 down payment. The mortgage is going to be $800,000. Closing costs are going to be around $25,000. So altogether, these 3 partners are invested for $225,000, meaning each of them is invested for $75,000. Now, when you're entering into a joint venture agreement, there's usually some stipulations for how long you intend to stay in that arrangement, whether it's like a 5-year and then you reassess, or 10 years down the road. And that's where the conversation between us comes up. So we are trying to determine what the principal recapture is going to be, what that passive appreciation could be in that time period, because that's more equity that each partner essentially has. So in this example, we looked at for 5 years. So the principal recapture on the $800,000 mortgage would be about $90,000, and based on a super passive appreciation of 2%, just because I know everyone is super cautious right now. I know most people go with 3%, but just to be really conservative, that would equate to about $100,000 of passive appreciation over 5 years. So if you add all of that up, each partner after 5 years would have approximately $140,000, $150,000 worth of equity in the property. And that is what I would propose covering. So if something was to happen within that first 5 years to one of those partners, one of those three, then there would be the $150,000 or $140,000 insurance policy that would buy out that partner's interest, and then the remaining two partners would stay on the title, and that the passed away person would their estate or their spouse would have their money out of it, and not be a part of the overall process anymore. And this can be done really cost effectively. It's one of those things you would build into your overall cash flow analysis. So if the three partners, for example, were 35, they'd be looking around $30 total for the coverage for all of them. If the three of them were 41, they'd be looking around $43 a month for a total. 51, about $82 a month for a total. And if they were each 61, then it would be $230 a month for all of their coverage combined. So you would just build that in. And if you look at how much, $230 a month, even if something does happen, then that is a really low cost to be able to really simply buy a partner out and then have the two remaining stay in that transaction. So yeah, it can be a really simple discussion, and I think it's one that is warranted when you're entering these type of arrangements. So if anyone is looking at going into that type of transaction and unsure of how to kind of work through who needs what type of coverage, then that's something that I'm happy to kind of go over.
I'm glad that you're touching on that point too, because I think in a lot of cases, this is a topic that I would probably guesstimate that most people who enter into a joint venture partnership or agreement don't talk about. Most people say like, yeah, everything's going to be rainbows and butterflies and unicorns and lollipops for the next 5, 10, 15, 20 years. Nothing bad's going to happen. Don't even worry about it. I got this kind of thing, right?
Well, that's the thing. And even more so for younger individuals, because we think we're invincible. So 100%, it just is what it is. We don't think something's bad's going to happen. We don't like tiptoe around the tomorrow, oh, I'm going to die tomorrow, or I'm going to be diagnosed with cancer tomorrow. That's just not how people think. It would be super weird if that's how people thought. Mm-hmm. But like, especially like with what's going on with the COVID-19 thing right now, people are like super hypersensitive to, oh my gosh, what happens if I got sick and I passed away? So I don't think that that's going to stay. As soon as this is lifted, I think that people's perspective about that it'll revert back to our normal invincibility stage. But yeah, unfortunately, things happen. I know a ton of realtors that have seen this happen to clients, and it's never pretty.
Yeah, I think that's key though. It's just like making sure you're having these hard conversations up front initially before you start, getting sick, for example, because then you're kind of up the creek without a paddle perhaps. And having all those expectations set on day one is so important, so that everybody's communication and stuff is just kind of on par moving forward, and you all know what happens in random ass situations where like, oh yeah, you know what, I've lost a foot in a bowling accident, and all of a sudden I can't perform my duties. Well, guess what, there's a clause for that exact same thing. And so making sure that you have a robust joint venture partnership agreement that has all those what ifs kind of in place, and this is a great thing to talk about and include.
Yeah, I think it should just be one of those bullet points that's in there. If you don't get the insurance, at least how you're going to address it without it then. So that it's not as messy as it's not as dirty as it could be, I guess.
Yeah, and the joint venture agreement is really just in place for when things go wrong. In most cases, nobody's ever going to use a joint, like rely back to a JV. JVs are only built for, for fact checking and for what happens when things go wrong.
Yeah. Which is kind of the idea behind
Insurance.
any type of insurance in the first place, no matter what type of insurance it is, because I don't dream of the day that my client calls me with a death claim, right? Like, these are protecting people in the worst case scenarios. They're not things that I hope someone never ever needs the coverage. But if they do, or when they do, then it's going to be a load off of their shoulders, having, whether it's a joint venture agreement in place or one of these type, or an insurance policy. So it's the same kind of premise behind any of those contractual, I guess, documents that lays out how we're going to deal with things. So, all right, so we're getting closer to being done. Let's see if I can get back to this. I'm just going to quickly touch on insurance as an asset, because I've had a ton of people reach out since mid-March, when the markets kind of went to poo, and how volatile they've been since then. A lot of people aren't aware that necessarily that there's different types of life insurance policies. So there is permanent whole life insurance, and then there's term insurance, which is very similar to buying a house versus renting a house. One of them is essentially purchase a whole life for your whole life policy, and the term life insurance, you buy a term 20, you have it for 20 years, and then it's done. So similar to renting in that regard. But only the permanent whole life type policies build up cash values over time. And these cash values can either come in the form of guaranteed cash values. They can be paid out as dividends, depending on the type of insurance policy, an annual dividend. There are universal life products that offer different asset mixes, and you can earn interest, you can earn dividends. It really just depends on the asset mix that you end up going with. But all of these essentially accumulate within almost an investment pot within the overall policy, and that they grow on a tax deferred basis until you actually go to take those funds out of that policy. It's kind of like your TFSA or your RSP in that regard, that it builds tax free during that time period. So for example, like a participating life insurance policy is a permanent policy that a portion of the premium goes to cover the monthly cost of the insurance, and then the rest goes into that investment pot. It gets an annual dividend that grows, and again, grows tax sheltered until you go to take those funds out. And I've seen a number of people use that cash value that they have built up in there. You can either withdraw those funds and use it to purchase a property. I've seen people borrow against the cash value in there, so actually take it to a bank and use that as collateral for a loan, and then go and purchase a property that way. So there's a lot of, I guess, just unique situations that you can use with that type of product. And I think it's just an alternative asset class that people are kind of considering right now, because even in the recessions, 2008, 2009, 2011, and way before that, the insurance companies that offered these type of products paid a dividend. Even when those times occurred, the product would really lose its value if it didn't offer that. And they're paying a decent dividend on a lot of them, and this product isn't right for everyone, but it really depends on looking at your whole situation and seeing if this would be a good option for you to accumulate additional funds and potentially use for real estate down the road, or just use as an additional asset in your overall portfolio. So just something I wanted to touch on.
Yeah, anything more we can leverage to buy more real estate, I'm game for.
Right? And then finally, just some industry updates. So in the past month and a half, there's been a ton of changes almost in every industry just because of this COVID-19 thing. So now almost every online application can be done without a wet signature. So everything's gone electronic signatures. In terms of the medical requirements, they've really eased off on what they require. You used to, depending on the amount of coverage, need to do like see a health professional that would ask questions, potentially get blood and urine samples. And because that's pretty one-on-one contact, that's obviously been eliminated. So right now they've really broadened out how much coverage you can get without having to do anything like that. You just have to answer the medical questionnaire. So for people that don't like having to give blood or have been kind of putting it off because they didn't have time or they didn't really want to go through all that, it might be a good time to consider it now that those requirements have been eased. So yeah, it's a really great time to just kind of review what you have, see if it's right, if you have that extra time, kind of like that to-do list. This always stays at the bottom of the to-do list, and maybe now we're starting to cross some of those things off. So hopefully some people can get this super exciting insurance crossed off while all of this, all of our home time and hibernation time is happening.
I actually have a quick question on that before you talk about this one. Does, you were talking, I think, about the MPP plan, maybe, about how being generalized into like a 50-year-old bracket ended up being more expensive than you having a individual kind of consultation and reflecting onto like the specifics of your circumstances, like how healthy I am versus like my age group. Are we going to see as an industry kind of like that insurance become more expensive because we're not getting these individual specifics like blood test, heart, like urine, all that kind of stuff?
No, no, it's not. The prices aren't like, they're not going to get more expensive necessarily because of that. I've been told that just because of the COVID-19 worries that some providers' plans, just in general, their rates might go up, but not because of health, just the overall rates, just because of there's an additional risk factor out there that's pretty prominent for them right now. And there's really no way that they can take it into account. But in terms of, they're still doing a very thorough questionnaire that I have, like the insurance provider have to administer. We're trained to administer those. And they also still have access to be able to order an attending physician statement from your doctor and to go through something called the MIB, which is the Medical Information Bureau, which lists all your medical history. So I don't know, you did a test, like a drug test at one point and it dinged off. Well, that's going to be on there. So they're going to see that. So they can still have access to a lot more than the MPP per se may. So if they want to look through those details, they have the ability to do so. You're giving them that option by doing the application. So they can get as thorough or as not thorough as they want. And then it's really up to them, right? They're going to look at your answers and look at your overall statistics and see if you're a 30-year-old that hasn't had like really realistically anything, or they're probably not going to be ordering a statement from your doctor. If you've had history of diabetes, they are probably going to be doing it.
Gotcha. Thank you.
So I think that's all for me. Now, unless there's any other questions, I think you guys kind of asked them as we went, but if there is anything else, I'm happy to touch on those now.
How can people reach out to you if they want to get a hold of you or ask you any questions?
I think the slide deck is still right.
Right there. I'm looking right at it going like, yeah, how do people reach out to you? Yeah, right here.
Maybe I disconnected it, but I think it's still there.
Nope, that was completely me. I was literally staring at it going, yeah, let's hope people reach out to you.
Perfect.
Maybe Megan, do you just want to drop your contact information in the chat so everybody can copy and paste it into their own?
Yes, absolutely. And yeah, I'll post that CBC Marketplace video also in the community. If anyone wants to take a peek at that, since you have free time. And just in case you're not getting enough insurance talk tonight. And yeah, reach out if you have any questions. You can always tag me in the real estate, in the community, and ask me your question there too if you don't want to do it one-on-one.
Perfect. That was awesome, Megan. Thank you so much. Everybody give her a round of applause in the chat, or Steve and Randy were here on video.
That is amazing. And we are ready for our next presenter here. Let me just make sure I got the right slides up.
I had to make this clear at the beginning, Steve. You're Steve too. This is my space here, bro. I grew up like Steve 1, 2, 3, 4, 5. Like there was Stevies, I was Stevens, which I only got talked to when I was in trouble. But
That's good. I love it. Well, thanks for having me, though.
Cool. I have a slide here if I could get my computer to work properly. Here we go. This one.
I like seeing the three of you. Oh, you're shutting me off. There you go.
There we go.
Hey.
This is, so there's Megan. There's Steve Pearce coming on tonight.
Yeah.
He's an American professional baseball player. He played in the Major League Baseball. He played for a bunch of different teams. And if you didn't know, Steve Pearce is only the second player in MLB history to have played on every American League team in the East. Steve, that's quite the accomplishment, man.
Hey, thank you very much.
For those that don't know, if you Google Steve Pearce, this is the guy you'll find. If you try and find much information on the other Steve Pearce, it is a little bit harder. So I have some information for you on the real Steve Pearce. Here he is. He is a commercial broker for First. He's been in the industry for 7 years, specializes in all kinds of different stuff. He's very active in the industry, sits on a ton of boards and does a bunch of presentations for different organizations and companies. He also is a big part of the community. He's been part of organizations such as Think Local First and Help Fill a Dream. He's a wealth of knowledge. I chatted with him for a few minutes the other day and was blown away and said, dude, you're the guy to speak for us. And then we chatted again today, and just some of the information that he dropped is absolutely amazing. So Steve, the stage is yours. And
Excellent.
I don't know if you don't have any slides, right? We're just doing this as a Q&A.
Yeah, well, it'd be easier that way, because if I put slides up, we're going to have people throwing daggers at me. So we'll just leave it to the questions you ask me. It's a pretty tough time right now. Hard market, as Megan knows. So
totally.
Well, I guess you're safe in a sense, though, from social and physical distancing. So you have to have a pretty good arm if they're throwing daggers at you.
That's right. And as you saw, I have a pretty good arm myself. So
yeah, you just bat them away, right? Samurai style.
That's right. Excellent. So yeah, so wherever you guys want to start, I'll let you guys lead it, because I think it's best, you know, the questions that people have been asking you. So ask me and see if we can put some clarification around that. But thank you for having me.
Totally. We'll start by saying, man, the real question, what is really happening with the strata premiums? And is it actually as bad as the headlines say? And can you maybe just walk us through, you're filling me in a little bit of why the strata premiums and all the other home insurance premiums have just skyrocketed in the past little bit? Just shed some light on that from an insurance perspective.
Right. So, sorry, one sec there. So what's happened is in the media, you have seen, I think we have it now, about 12 buildings have really have been hit hard. And the reason being is, one is the size of those buildings. They are absolutely massive. And to actually get the capacity to cover those, the different brokerages and insurance companies, they're really looking for capacity, and capacity has become a real struggle because of claims. And as Megan alluded to earlier, insurance is not a maintenance program. It is an asset protection program. And the maintenance of, say, strata buildings, for instance, if I was to use a really good example, is the BC Strata Act, of course. It dictates how buildings are covered. But as well, there are very important best practices that have to occur. So the Strata Act states that a building must be insured to replacement cost. So obviously, the best way to figure that out is to have a building appraisal. Having a building appraisal, of course, costs money. So when it comes to some of these losses, what ends up happening is you end up to be in a position of co-insurance, or they'll have a stated amount. So I'll use a perfect example would be the Strata Board decides that they would like their building to be insured for $50 million. They just decided that's what they came up with because it just seemed like the right number. The actual cost to replacement cost of that building may be, let's use a number of 100 million because of increased costs over time. A lot of these strata buildings too are a lot older, we're talking about 70s and 80s. They're the ones that are affecting the whole market. So their bylaws are very old. They usually, say, I don't need a property manager. We're going to do this ourselves and manage it ourselves. And we will vote against the Strata Act and say, we're not going to get depreciation reports because it only takes a 50% vote to not get one. We'll decide not to get an appraisal. We have a friend who's a contractor who kind of knows the price. So let's take that $100 million building that's insured for $50 million. There's a partial loss on the 20th floor, which is a toilet that breaks, that causes $1 million claim. Because guess what? That's going all the way down to all the other floors. These are the buildings that you're seeing the claims on too, they're seeing these increased values of premiums because those claims are being paid out. But now because the market's hardening, as they say, the capacity is gone to be able to find enough insurers who are willing to cover that building at the actual value, because after they have a big claim, now they find out, oh, we do have to insure for $1 million, because at 50 million, we were penalized 50% of the claim. So if it was $1 million claim and you were only insured for 50 million when it should have been 100, you're only going to get 50% of your claim covered. So only 500,000 of that $1 million claim is covered. Now you have a legal battle. Now insurers go, oh, we don't even want to be a part of this strata business anymore, so we're leaving. Well, now you got to find other insurers to fill those gaps. And those other insurers that come in say, yeah, we'll come in, but our rate, instead of 10 cents on $1,000, is 30 cents on $1,000. So you can see two things have happened. One, the increase has gone up because the building value has gone up 50%, and the rate's gone up 3 times because the last participating insurers want 30 cents instead of 10 cents. So everybody goes at 30 cents. So that's 3 times. So 3 times and 2 times is 6 times. So that's where you're seeing this thing in the news of our insurance has gone up 6 times. That's not always the case, but that's been the majority of those ones. Then you have the big, beautiful buildings such as the one in Victoria, Shoal Point. That building is big and beautiful, but it was being insured at rates that were less than what the rates were in the 80s.
Wow.
So what happened was about 7 years ago, I don't know how many people are on this call, and maybe a little longer, go 10 years ago, or even maybe a little longer. We'll say when Christchurch had their big earthquake, and earthquake rates went through the roof. So everyone's insurance seemed to have doubled and tripled. Well, those rates when I came into insurance were around anywhere between 25 and 30 cents per $1,000. Well, since then, in the last 7 years, those rates have all now dropped down to 12 to 16 cents per $1,000. Well, if they were at 30 10 years ago, and now they're down to 12, and now you have this hard market, you can just guess it's going up. It's going to go back up to 30 again, at least to 10 years ago rates. We've been able to keep the market actually more stabilized with what we're doing with our plans, and what some other insurers are doing too, as well as we're able to look at just doing a 10% increase or a 15% increase across the board. Because we negotiated that with the insurers, they allowed us to only have a 10 to 15% increase rather than going all the way from 15 cents to 30 cents. They're like, okay, yeah, we're okay with the 18. Thank goodness, because it was very stressful. I felt like the mortgage brokers did probably in the 80s when they had to tell everyone that their interest rates went up to 24%.
The Grim Reaper.
Yeah, definitely. So yeah, I really do, because I really have full control of this, not at all, but I am the messenger, and people just don't like to see that.
Yeah.
So that is part of it. So it's really important for people to understand that insurance is an investment, and the reinsurers have investors that invest capital. That capital they invest is the amount that's available to pay for claims. So there's two things that are playing here. One is capacity. So if an insurance company only has capacity for $100 billion in buildings to be insured, well, I'm sorry, that does maybe downtown Vancouver. Like, we're not even touching downtown Vancouver yet with the $100 billion. Those buildings are expensive. There's lots of them. Now think we still have the rest of the population, or the rest of the buildings across Canada, which they would rather insure because their buildings are maybe newer, they're concrete, there's no earthquake exposure. So the reinsurers are okay in those other markets. Whereas in Vancouver and the island, with they're waiting for the big one, they keep saying, but it's not that they're waiting for it, it's just a bigger chance, there's a greater chance of it happening here versus somewhere else. Therefore, the reinsurance market is not allowing the capacity to the insurance companies who write the premiums. So that's where we're at right now. It's not fun.
Yeah, I can't say that I feel your pain, but I appreciate the efforts that you're working hard on your clients for.
Yeah.
My stepmom's in insurance, and her and I have had a couple of talks around this topic as well. And yeah, it's tough days, man. I've just appreciate you being here, being able to share the value that we're going to rock through the next little bit on. And I'm curious, like, especially here, South Island. I think it's the same in Vancouver as well, but most of our community here is kind of tuned in from the Victoria area, from here, or live here. I don't know if you're from here or not, but I would say the majority of our inventory here that is strata is from, the last building boom of, the 70s and 80s, really. Like, I don't know, half of the product here is probably from that era.
Right.
Is there, if that's the main issue of older, bigger buildings that are from that area, their crappy pipes bursting and leaking down the 10 floors and damaging everybody's, and obviously that's kind of where this is kind of driven from. But is that something that we need to be concerned about now? As me, as a buyer, I live in Cooksey Village, so just across the way there's a 1974 building there that's, I don't know, 50, 60 units. If I was looking at buying one of those because it's got park views and I can rent it out to make cash flow, should I be concerned about that particular place? And what are some things what would be your advice to a buyer of that product now today? To do your own due diligence on.
Oh, I know exactly where you're going with this. So we deal with a lot of developers, and right now the look is anything that was built pre 1975, say, from then until the 90s, do not have the lifetime existence like the ones that were built from the early 1900s till that time. The structures were put up quick, aluminum wiring, the plumbing was different. There was a lot of, it was just really interesting to see how they were all built. And right now, the speculation for Greater Victoria in those areas, they're all going to get repurposed. And what I mean by that is, they can say repurposed, repositioned. You will see a transfer of where someone's going to come in, buy the whole building, give you 25 cents on the dollar, because either you're going to spend the money because bylaws are going to come in that you have to update plumbing, electrical, your heating systems, roof, like who has the contingency fund. So any of those buildings down there, they average around $7.5 million. You'd probably be looking at an infrastructure cost for most of those around $3.5 million, just to get up. And then once you start to do that, guess what's next? Sprinklers. Then you have to put in different infrastructures. Oh, right, we have to do seismic upgrades now. Okay, let's add another $2 million. It'd be everyone's gonna just walk away from it. Here's my keys. See you later. So that's not what's going to happen yet, but that's what's going to happen in the future if somebody doesn't come in and put a bunch of infrastructure in there. Mm-hmm. That's what they're preparing for as well, with all these new condos that are going up. And that's what the West Shore is hoping for as well, is that we're going to build it because you're going to need to move there. So does that answer your question?
For the most part. So no, it actually doesn't. So for me, if I'm like, I write the offer on this place, it gets accepted. There's a strata in place already. What is something that I need to ask either my realtor to figure out, or the strata council to figure out what is this going to be a concern for short premiums going down the road?
Yeah. So the first thing you should be seeing there, especially with these older buildings, depreciation report is a must, as well as a maintenance report, how it's being property managed, and what the contingency fund is. Those are the most important things right now, and that's what's going to allow you to weather the storm through these changes that are going to incur. The Strata Act is changing. Right now, you can vote down the depreciation report at 50% vote, but because of losses and insurability, that's going to change. I mean, it'd be like walking into because you're buying into a business. Mm-hmm. Would you buy into a business, or as a person, would you purchase from a meat production place that only cleaned their machines once every 3 months? Probably not. Yeah, exactly. So you got to think about this. This is the same way as these businesses are being run. You keep them clean, like your house or your inside of your unit would. You'd expect to see, what is the hot water tank program? How many inspections do you have? How often is the sewer rotor-rooted? Is it every year or once every 5 years? Because those maintenance programs are so important, because the way the Strata Act is also positioned and the way insurance rates are going up, stratas are choosing large deductibles to keep prices down. So when you go in, you want to ask, what are those deductibles right now? Because you might not even be able to get insurance for those deductibles in the position you're at, and you're going to have to change carriers maybe, or go to a different company that can offer a $50,000 water deductible, which is called loss assessment deductible. That's another portion of your unit owner's product. And then on top of that, you need to realize, if you're renting that out, you better have an agreement with your tenants that they buy insurance, because you're liable for that too if they cause the water damage. Mm-hmm. So those are the things that we're seeing come back more than anything else, is that the unit owner just feels so tainted that they were not provided all the information going in, or realizing that you are buying into a business. So know the bylaws, know what your obligations are being a unit owner in that strata. So it's worth those checks.
Yeah, I just bought a condo. I bought 2 condos, one in 2012, one just recently, and this most recent one, because of the concerns around, or maybe the drama, that either way, I did a lot of due diligence on the on the insurance policy in place, and it was just about to be, it was just reviewed and renewed, and for what I know is all good things. But something that was brought up by my home inspector was the percentage of my strata payment. Say it was $100 a month. It was 18% of that, so $18 a month was going to the contingency fund. On your side of things, do you want to see the number be a lot higher? What's like a rule of thumb for that?
Well, we actually don't dictate that. That's what the depreciation report dictates. So that would come from the property appraiser or assessor, whoever's doing that. Gotcha. And then with the property manager and the strata board themselves, they would calculate that out. So it would show you on there, for instance, let's just say if there was 25 units, the roof replacement, it's 100,000, and you have 5 years to do it. You can do the math there. That's how it's going to get divided in. Problem is, that's for that. But what about the what ifs? Balconies rot, or you have water ingress and it's a leakage and seepage issue. Those are all going to be costs that come over and above. So yeah, the nice to haves and the need to haves are two very different things.
Very true.
Yeah.
We had a question inside our REINVESTORS community, and it was a half question, half statement. And it was a lady posting, she said, "Hey guys, I know you have an insurance guy coming on today. I wasn't expecting our insurance to be affected since we were a duplex, but it seems they're charging us a hike of 60% this year. Does that seem normal, and what can I do?"
Again, couple things. Why was it increased? Was there increase in the building value. That could be part of it. The other part is some insurance companies are wanting to get out of the strata, especially the strata duplex side, because they're a lot harder to manage, because there are just the two people that have to make the decisions of everything. It's hard to have a strata board of two. And so they basically increase prices because they want out. And it's what they call it, forced shopping. So sometimes when that happens, it's worth making the call to a couple other insurance brokers in Victoria. There's so many good ones out there, and it's worth asking them, you know, who knows why. There's so many other things that could have happened. I'd have to see it.
Totally. Is there a firm or a brokerage that specializes in different things that we can kind of blanket statement, or like you said, that they're looking to get out of maybe that insurance policy, so they're doing forced shopping? Is there somewhere you can say like, hey, these brokerages or this type of brokerage will more than likely look at that instead of having to call all the different ones to find? Or is it literally just shotgun style and call as many as you can to find out what's up?
Yeah, well, and everybody has, well, that's the other thing. That's a good question, because many brokerages have the same markets. So right now, that is the tough part. So I'll use an example as a, we see policies from BCAA, and no offense to anyone who works for BCAA, if anyone's on this call there, but we'll see strata policies from them, but they don't have any commercial general liability. That's mandated as law in the actual Strata Property Act. So when you see those things change, and then someone moves from a duplex BCAA policy to another carrier, well, everybody else knows you have to have commercial general liability. So all of a sudden your price increases. So I would technically try and stay away from them unless they're going to offer that. CGL, it's commercial general liability. But for duplexes right now, I mean, I'll say First is, we do a lot of them. I have this past year for duplexes, I personally in my portfolio did just over 800. We have, next one would probably be Westland's. Okay, if it's a new duplex, Westland will look at it, who used to be Brown Brothers. Another one would be Christie Phoenix. They offer some stuff for duplexes. Hub Insurance has a good program as well. So those are your main ones. Henry Swint McKenzie is another one. They're a nice small local place. I like to promote the local businesses, to be honest with you, that are in Victoria. That's getting less and less. There's Thunderbird, First, HSM. I don't know if there's any other. I think everyone else is owned by venture capitalists, or yeah. So
I think
that's.
Sorry, I didn't mean to cut you out there. Because of COVID and a lot of the social distancing that's now taking place, I'm assuming that like online insurance policies are probably ramping up in terms of volume here. Is there anything to be concerned about as me as a buyer for an insurance policy by shopping online? Is there an additional benefit that comes with working, directly with somebody like yourself, or can I just hop on and is it like the Amazon of insurance? I guess go to Square One or whatever it's called and done. It's delivered immediately.
Well, like Megan said earlier, it's not necessarily face-to-face, but you can do this obviously too. And I do a lot of these meetings. Having a voice on the other end who is, when you're doing it online, you're left to your own vices to click and unclick and change and do whatever you want, but an individual doing it online themselves without having any type of advisement is very scary, because you don't know what you're getting covered for. There's a lot of brokers out there that are very scared of it because they know that the unit owners within a strata are doing that. And so are they reading their strata policy and then just deciding what's close? It seems close enough. Yeah, it's good. So everyone tries to reduce costs. Right now in insurance, and Megan said it earlier too, costs are not the most important. Premium is not the most important thing. Covering your assets assets is the most important thing. Unless you have a disposable income 10 times your investment that you're going into, you'd be crazy not to get proper insurance, to talk to an advisor.
My advisor always told me, she said, when your condo is leaking and there's water pouring out of the ceiling, who's the person do you want to call? Do you want to call the automated system, which you signed up for, or do you want to call me? And I was like, I want to call you every time. And she's like, that's why you come with us and not somebody online.
Exactly.
That kind of stuck with me, is like, cool, it seems easy and simple now, but when there's water pouring out of your ceiling and you want somebody to have your back, do you want it to be a computer that you automated through, or do you want it to be me who sold it to you, that knows you and is going to be able to help you through the process? So
yeah, you need someone to yell at. That's what it is. Honestly, who's not going to take it personally? That's right. Yeah.
I had a quick question. Maybe I'll go this way. How is COVID-19 changing insurance policies, and is it having any effect on you guys as an insurance group as a whole, or insurance owners, or if they're going through claims? Like, how is that affecting you guys as an industry right now, if it is?
Well, it totally is, because of the interaction portion. ICBC probably the most, and then homeowners tenancy policies, because there's a requirement for technology. It's very difficult to get someone who's maybe they still have a flip phone, or they don't text, or because everything's through email signatures, or you have consent forms that are sent back and forth. So it's a very slow process. Where we were doing 700 transactions a day, now, depending on who calls in, you may only get 20 done. Like, it is unbelievable. It can be very stressful for all parties. When we first started this, we had a 7-day waiting period. It wasn't fun, because we had to reset up everybody at home. So right now with Pearce, for instance, we have, of the 70 people, 60 people are working from home. Pearce went and they got the IT company, set everyone up in all their different workstations at home. It is phenomenal.
That's impressive.
Yeah, it was really neat. And then, on top of that, they do this whole, providing a lot of things, but that's outside of the insurance side. It's just what they're doing as a company. But when it comes to the, the COVID-19, nobody knows what's really going to happen. The business interruption side of this, there's class action suits coming out. There's all types of things that are happening. And people don't realize that most mutual funds, RSPs that are purchased, have an insurance reinvestment side to it. It's going to be really interesting to see what happens going forward from this, because there's going to be a hard market pushing forward that's going to affect all lines of business. So this isn't something that's just, there's a chance of earthquake and it's going to affect that. This is affecting roofers and builders and homeowners and, restaurants and pubs and everybody. So those costs and that downturn, they're going to weather it. But the request rate now on keeping buildings safe, the cost of, look at theft has gone through the roof, 600% in commercial buildings. Fires have increased. The stresses that are happening around that are all being affected on insurance. So when you can't be face to face with people have a hard time. They lose that personal touch and what the meaning behind words are in an email versus having a conversation. So I do stress to people, if you can pick the phone up to talk to someone versus sending an email or a text, if you're angry, find a good way to have that conversation, because you'll get through it a lot better and get through what you need done with a lot less time spent versus assuming what someone means in an email. So I hope that helps.
Totally.
Yeah. So yeah, it's gonna be strange going forward though. We're really worried for small business right now.
On the real estate side, obviously there's a scare of vacancies right now, and we as as landlords, always when we get insurance, make sure we have vacancy policies in place and things like that. Is COVID going to trigger any of that if tenants just up and leave or bail out on properties? I know it's more so around like water damages and those kind of claims, but is there any instances where we're going to see that? And then after we're done that, I'd love to just ask you about, as an investor, insurance policies, what we need to know about them for having, rental insurance through our tenants, not through our tenants, not tenant insurance, but vacancy insurance on our rental policies, and the importance of that as well.
I don't know. I don't know if I've seen vacancy insurance. Do you mean like insurance
like loss
when
of rent?
Vacant?
Like loss of
loss
rent.
of rent. That will incur. It has to be. It follows property. So civil authority to closure follows a property loss. So that's fire, flood, earthquake, falling objects, or if say gas leak in your area and everyone had to be evacuated, that's different. Because of COVID being an extraordinary situation, there is not, it doesn't follow a property damage form. When right now the speculation as well within the developer side is that rental requirements are going to go up. You're going to have more and more people who are sitting there waiting now that we're going to buy a place. They're living in mom and dad's place and they were just saving up. They're now going to go back out renting again. Because we write so many policies and we see them where they add in other family members in their homes that are waiting to buy a place and they're waiting for this market to change or save up. There's going to be a renter's market still. And I think what the other problem though is that the government put legislation together that you're not allowed to kick anyone out that's not paying rent, right?
Yeah.
So what you can do to adjust your rental incomes or to adjust your insurance is just say, well, they're not paying, so what do we do? It's going to save you a few dollars. It's a very small part of your insurance cost, but it's a very important part when it comes to if there's a loss, to make sure you have that cash flow. And to all of you out there, when you're looking at rental insurance coverage, if you have a building, let's look at it this way. How long do you think it would take to rebuild that building? That's what you should be looking at your cash flow position. So if you think that a 1980s building that you own a unit in is going to get rebuilt in 12 months, I'm sorry. By the time it gets cleaned up, rezoned, rebuilt, probably put commercial down because that area, look into the bylaws for those areas. That's the other thing I would do as a unit owner or building owner of any type. Look into the bylaws of what needs to happen if there is a total loss. Underground parking has to happen, whatever it may be. Well, that all takes time. So 18 months to 24 months for rental income is a good choice. Just to put that out there.
That's a really good point, actually, especially probably now more than ever if you're buying a home tomorrow. Like, I know some municipalities aren't even approving any permits right now. So if tomorrow you buy a place and the next day it burns down and you can't get any rebuild permits, you're just sitting there waiting all over again.
Yeah. Yeah. So that rental income is really important. I mean, it'll pay your mortgage for a long time, right? And some. Definitely. So again, I don't know what's going to happen this COVID, but I believe there's going to be more renters than non-renters.
So you're saying it's a good time to go buy some income properties?
That's what I'm doing. No, I don't think the prices are going to change too much either. I think value is going to stay up, to be honest with you. There's so much need. People still want to live here. There's so much disposable income and people want to live here. This is we're in a retirement place. So service industry retirement.
One thing too that'll just make Victoria an even hotter commodity going forward is there's going to be a whole bunch of employers that realize now that they can have their employees work remotely.
Yeah.
And if you were stuck in Windsor, Ontario, and your employer's like, hey, you can go live wherever you want now because we have things like Zoom, like we're all on now. great.
Mhm.
Well, I'm packing up my bags and I'm moving to the coast, baby.
Yeah. Oh, exactly. Hey, there's another thing in you saying that. Something to really pay attention to is City of Victoria's 3.0 is going to be launched.
Hmm.
Please, please look at that so you can see what the strategies are for downtown Victoria and what Greater Victoria is going to be doing. So they're just revamping it. Their council just approved the changes. So, I mean, they're looking at things of building a tech park where Sports Traders was down in that area to be much like a smaller version of Mars, which is in Toronto. I don't know if you're familiar with Mars in Toronto, but again, look at those things. Downtown core is going to be very neat. So yeah, those are going to be some neat things that are going to come in. And so more and more people are going to get attracted here to work here. And SIP, which is the South Island Prosperity Project, again, I sit on that economic task force with those individuals looking at recovery going forward. And our focus is to see more and more people being reliant on the core buildings that do exist now and the infrastructure costs that are going to be put in by the government and by the municipalities to make what we're going through now more manageable into the I guess into the recovery stages, because the new normal, we're still going to be separated. So that means more people are going to need more spaces, really.
Yeah, I couldn't agree more. I think that Victoria's got a huge amount of upside still to go. Like I was at the Ross Bay, where Sports Traders is. What's the Rock Bay?
Yeah.
Like proposal or whatever a few months back. And man, they got some cool ideas. I'm really, really excited to see that area develop as well as the other kind of like peripheral areas. So there's tons of demand still here. I think one of the last questions we have before we start wrapping up, and we can get into some of the attendees' questions. But what do we as investors need to know about like tenants insurance? So big question, right? And how necessary is it? Because I know a lot of people out there that have 1 suite or 20 suites and no renter's insurance.
So you're taking on 100% liability of what they're doing. 100%. If it's in a strata, I know you can't force people to buy insurance, but you can educate them. Let's show the videos or the clips from the news of how many people have said, oh, our building just burnt and now we have nowhere to live. Your tenant's insurance, this is the important thing to know. Tenant's insurance is also their personal liability, and that's what's going to help the unit owner if there is a cloth left in the sink or the tub overflows or they have something goes on and they break the toilet, or the worst ones that I've seen lately are the tenant decides they want to buy a new fancy fridge because they want ice. And so they go and they hook up that hose themselves in the unit for the water line or the dishwasher they decide to put in. And that line goes that they've done. And not only does it damage your place or every other place that's around there, who knows what your tenant improvements are as well in your unit that you've bought, because if it's an older building, that might have been updated 6 times. So the tenant improvements or unit owner's improvements lands on the unit owner themselves. So having that tenant's insurance for liability alone is number one. Number two, if something happens and they have to move out, their tenant's insurance covers loss of use, meaning it will cover them to go move into a hotel or another place for a period of time. It's not just for covering their contents. I mean, man, like you can buy a lot of stuff for 30 grand. And I know out there right now, there are policies that start at $180 for unit insurance. There's even people that I know of that have been giving discounts to, and I don't know what the legalities are around it. They've been giving discounts to tenants that buy insurance.
That was going to be my question: is would you consider tenant insurance being to the point of importance of, docking rent by $25 just to make sure that they go and get tenants insurance? Oh, we might have lost them. Steve, if you can hear us, you're frozen, bro.
maybe you and I could just talk on that for a second then.
Yeah, sure.
The importance of tenant insurance and how we as landlords can enforce that, and not enforce that, but encourage tenants to go about that. I know for us, one of the things that we always do is we put inside of our lease agreements, it says we encourage all tenants to go get tenant insurance. And one of the things is we can't force them legally. You cannot force them to do, and we talk a lot about this as landlords. How we landlord is we play above the line. We don't try and do shady stuff. We don't do, last time we talked about charging 3 months for rent or 3 months rent for holding the place and stuff. One of the things that we do is we actually say to them, hey, we can't force you to get tenant insurance, but these are the reasons why you're going to want to go get it. And we would love if you would. And we just lay it all on the line for them, have a little pamphlet for them. And it just makes our life a little bit easier so that when it does come up, it's a lot easier conversation for us to have and to be able to continue to get them to see the benefits of it instead of us saying that's an enforcement.
Mm-hmm.
Steve just texted me and said his power went out.
Oh, geez.
So he might not be joining us.
Gotcha. Megan, did you want to chime in there for a second? You said I asked your tenants to get it and took half.
Oh yeah, I asked when we renewed their lease in September, we didn't have to, but they asked to specifically do it. I asked them to get it and they took half of the premium off of their rent. It's a benefit to me for them to have it, so it was just a little bit of a nudge.
Gotcha.
So with Steve being Wi-Fi-less and powerless, unfortunately, hey, that's the cool thing about being online now is that we get to pivot and adjust with these awesome things that come up. I saw there was just a few things on the side here that I just wanted to touch on. I know, Kevin, you were asking about the different insurance companies. I hope we covered some of those. And then somebody else asked, can we post them? Yes, we'll get Steve to give us a list of all the local ones, as well as some of the other ones. We'll post that out in an email to anyone who attended, as well as the slides, I think, from Megan. I got to confirm with her if we can share those out. And we'll get those out to you guys. And Kevin did mention not to push tenants away from Windsor because he does have there. So
sorry, pal.
Way to go, Steve.
So
it was just the first place that came to mind. I was like, I don't know. I think I was talking to somebody about that earlier, but
Sherry definitely did bring up a good point that with the economy dropping and tourism dropping, tech is going to be our number one supporter here. And something we all need to keep an eye on is how tech is going to grow in this time while we are looking to be stimulated in some way, shape, or form because we'd lost tourism. So that's kind of the gist of it today. I can pull up the final slides. Steve just put out other Steve's information there. Let me just bring up the next slides here. Uno momento. So, oops. There we go, guys. Well, sorry for the abrupt ending, folks. That's just sometimes the way it works. Steve will be happy to hop on a call with us and do another Q&A or answer some more questions we have. So if you do have questions, send them to us. I will answer. He's such a giving guy. When I called him and asked him to come on, he said, dude, I don't want to promote myself. I don't want to promote my business. I just want to provide value and give as much information for your community as I can. So absolutely loved him for that. But if you are looking for someone in the insurance industry, definitely recommend reaching out to him. And as well as Megan Betker for coming on tonight. Really appreciate it. Been absolutely amazing having you share that information tonight. It was very, very valuable. If you did find tonight valuable, hop on Facebook and give us a review. That's how we're able to grow and expand and build our awareness. A lot of people do use these reviews and go through them and look and see. So If you did enjoy tonight, again, we do this stuff for free. If you want to donate, you can, but we do them for free. And so the way for paying us back, if we provided some value to you, is to hop onto our Facebook page and just give us a quick 5-star review, 4-star review, whatever you found, and then just share, always 5, and and just share that you found some value in it. If you found some value, something like that, because it really helps draw other people into our community and keep us moving on this movement.
Yeah, and if you want to, share it out too. Like this community is purposefully driven for us to reach 1 million people so that we can inspire them to invest into real estate. So I guarantee you've got friends and family. Let's bring them in here and let's start elevating our close circle. And then as our close circle continues to elevate, then our whole community does as well. So you can check us out there. It's just at the REINVESTORS. All of our handles are basically the same.
And if you have questions, that's where Megan Betker hangs out quite often, answering things and putting in her input where you can. So if you have insurance questions, and you can just pop them in there, and Megan will be able to find you very easily, as well as all of our sponsors are in there looking to support and help as well. Our next meetup is going to be, he made it back. He made it back. We can finish our quick conversation with Steve now, if he's...
Sorry about that. That was...
There he is.
Crazy. Sorry about that.
No worries, man. It happens. That's the joys of doing live presentations online.
Yeah, we were waiting for Hydro to come do our lines. I was just texting someone who's on the call here actually too, and they know that we're getting a new service, but we have a fried line out front, so it's not good. That's probably it.
Cool. So just to finish on that topic of tenant insurance, then we'll finish up, guys, for those of you that were just jumping off. To finish on that conversation of tenant insurance, it's very important for the 2 reasons that you listed. Do you want to just quickly recap those 1, 2, and then just finish off what you were saying?
Yeah, I was just saying it protects both. So it protects yourself and it protects the tenants and their family and their lives. And that the liability they get with the tenants policy follows them worldwide. So it's fantastic. So, they got kids and you decide to go to Whistler and you're playing in the pool at the Fairmont because you get a day pass. The kids chuck something, break the they hit the sprinkler up above. It sets the sprinklers off in the whole gym area down there and causes $300,000 in damage. Your tenant's personal liability coverage on there will pay for that for you.
Whoa, that's cool.
That is amazing. Yeah, so, and that's a true story, by the way.
Yours or?
Yeah, it wasn't my kids. Was it the hockey tournament? But it wasn't my kids. But yeah, no, that's one part of it. But you really got to look at it to protect your assets, and that's why it's there. Yes, there is a cost. And I was talking about the discount. I was saying that has been used as a discount to show that they have it or a portion of it. I don't know if that's something you'd want to advertise, but it is something you could do to help them pay for it. It's a good investment. And then the last part was, what can you do is build it into your tenant's agreement. I mean, you don't have to rent it to people, but once you've rented to them, you can't go back and say you have to have insurance. So that's to talk to a lawyer about. So they know those laws a lot better than I do.
Where can you send a tenant to get that insurance? If you were a landlord right now and you are showing tenants and you wanted to say, hey, like Steve and I were just chatting while you hopped off there, as landlords, what we try and do is we put it in our bylaws and tell them, hey, we can't force you to get this. All I can do is just give you the information on why it's important. One, where can they get that information about why it's important? 2, where would you send them to go get the tenant insurance?
You know what? Anywhere, anywhere you can. There's some great programs out there, and they can even apply for, I think there's incentivized things for low income as well through, again, BCAA or local credit union. First Insurance, we do a lot we have a seniors program, which is phenomenal. And it works really well for seniors. There's programs out there, of course, through, if you qualify wherever your place is through BC Housing, I mean, they have programs as well too, right? So that's what you're looking at. And it's making sure if you're renting to families and they've got foster kids, for instance, their liability is actually picked up by the province. So that program there. So those are good things to ask, as well as to make sure that those policies are in place too. So yeah, there's so much information out there. Knowing the Rental Act is very important, which I'm sure you guys have covered before. So yeah,
Our favorite topic.
yeah. Exactly. Yeah. Was it 3 years less a day? See you guys. You're out. No, I'm sorry. I do joke sometimes about things, but it's just because sometimes I have to be so serious so often that if I don't make it light, I lose more hair than I already have lost. So.
Well, dude, you can have some of mine. Look at this flop I got here from COVID.
Yeah, that's right. Someone's making a comment there. Please reach out for lawyers. What does that say?
Consulting to me through Steve. Cool. That's just somebody sharing some information for the call, I believe.
Okay, good.
And so just cleaning up for tonight, how can people find out more about you guys, and what type of policies do you typically offer at See First for everyone that's on the call if they want to look at getting some sort of policy put in place or come just shop policies?
Yeah, for sure. We were talking a little bit about that earlier. Shopping policies, be careful. We were talking a little bit about that because everyone has the same insurance companies, basically. Ask, when you're asked them, say, hey, do you have something that's, specifically different than what another insurer can offer? That's a big part of it. So at See First, we offer products that nobody else has. So if we give you a quote, you can go to another broker and get a quote, and we're not blocking that market is what it's called. We're not blocking that insurance company by providing maybe the wrong information. And that's the other thing, is that it's really important to do your due diligence and find out who is backing that insurance. Not all insurers are specialists in the markets. They'll offer coverage, but then that's when you're getting into this hard market right now, is that they may not be there next year. They just jumped into it because it's available now, and then we're out next year and now your prices go. So loyalty pays huge dividends. It's like the RSP long market thing, right? If you feel that you're really been financially challenged, as the word I'll use, if it really chaps your hide that much that the increase has gone too high, go shop it. Then go back and talk to them and say, hey, I'd like to stay with you, but this is what's going on out there and why. But loyalty is important. We're all good people. We all mean well. We all want to make sure people's assets are covered. We offer at See First, for instance, we do offer all property insurance for tenants, unit owners, building ownership. I deal with all the commercial stuff, so we put a lot of stuff into a commercial and commercial general liability point. Most people out there, if you're buying property and you're putting into a holding company, you're going to definitely have a commercial policy. If it's in your own personal name, you can still get a commercial policy. That's not a problem. It just goes in your personal name. A commercial general liability policy attached to that is so much more important for the coverages, because personal liability really doesn't cover you when you're off premises. So you got to remember that. So make sure that everyone understands that portion of it, and read your wordings. As well, when you're looking at large property schedules, there's probably a good 6 companies that are really good at that. And I'd like to say I'm one of them. So
Amazing. How can people reach out to you if they want to get a hold of you to see if you can do something for them?
Yeah, so Steve Pearce, so spearce@seafirstinsurance.com. I will send out an email to you with all my particulars that you can share with the group.
Cool.
I can look at, and another thing too is that I don't do this to make money. I do this to make a difference, to make people understand the insurance world. I want people to be comfortable with it. If you get your insurance elsewhere, I can help you ask the right questions. I'm totally good with that. Especially I do that for you guys. You guys are great guys in the group you have there. I'd love to do that. Yeah, it's what I do.
We
I
love
like to
that.
sleep at night.
We love that about you, man. I appreciate it from the moment you've chatted. This is the second time you've come and spoke to our meetup. You've always just been a giving guy. You just want to provide value and information, and never trying to just pour your brand out there or steal business. So that's something we really valued from you from day one, and so we really appreciate it, and we know the community does, and we're happy to push people your way just for that attitude, because then it means they're at least getting the right information and not just somebody trying to sell them. So that's something that we really appreciate. And yeah, thanks again for coming out, man. It's absolutely been a pleasure.
No, thank you. I appreciate it. Thank you very much. So, well, I'll leave you guys be, and you guys have a great night. And thank you to everyone for coming out and allowing me to jabber along here. But I'm going to send a document that I'll share with you that is quite long, that covers strata. It's going to be coming out from the IBABC, which is the Insurance Brokers Association of BC. And it'll be amazing. It'll be nice. It'll be very direct in its approach of what's happening in the marketplace and the responsibilities of the strata owner, the strata council, the property manager, what the Strata Act plays, and it's really neat how it puts it together. So, and then how insurance plays that role. So it'll be good.
We'll share that out to our community for sure.
Yeah. Okay, excellent. Well, thank you very much.
Awesome. Thanks so much, Steve. Appreciate it, man.
Peace.
Take care, man.
For the rest of y'all, just finish this off here. Our next meetup, Tuesday, May 19th. Same place. Wherever you are,
book it. Right from the comfort from your couch.
It'll be here. So be sure to check your emails. We'll be sending out more information around that. And sorry if any of you had miscommunications tonight. We're going to be changing up the system for next month, making it a little bit different and a little bit easier instead of going through Eventbrite. Just a tiny bit of miscommunication with new Zooms and Eventbrite stuff. It just kind of makes it a little bit challenging. So we're doing our best to adopt like everybody else. So I appreciate your patience. And if any of y'all need us, you know where to find us. All over on Facebook, Instagram, our REINVESTORS community. If you post in there, Steve and I see it, guaranteed. I guarantee it because we approve every post that goes through. So if you guys need any questions or you have anything, hop into our community, ask some questions. And again, if you need anything from Megan, please reach out to her. And same with Steve. Both people really just absolutely crushed it tonight. Really appreciative, and thank y'all for coming out. Cool.